Hi students, welcome to the video on financial accounting at your fingertips. In this video, we are discussing reconstitution of partnership. All of you know what is reconstitution partnership. When any partner retires from the partner business or any admission of partner or death of a partner, partnership is reconstituted. That means their profit sharing ratio and their partnership deed will be changed. So, in this video, that is glimpse of this video is first definition. What is retirement of a partner? Then what are the reasons for which the partners retire? What are the procedures to be taken into account on retirement of partner? So, main points which are required attention. Then some illustration will discuss and we will also know the accounting treatment. That means we will solve one problem relating to that retirement of a partner. So, when one member ceases to be a partner and remaining partners continue to carry on the business of the firm, it is called retirement of partner. One partner will retire and other existing partner will continue that business. So, it is one of the modes of reconstitution of partnership. We have already discussed. It may be due to admission of partner or retirement of partner or death of a partner. A partner may retire from the business due to his old age or misunderstanding among the partner, or there are losses in the business, or he wants to start new business venture, etc. How a partner get retired? A partner may retire by giving notice to remaining partner in case the partnership at will. Suppose partnership will means at the interest, at the will of the one partner, by giving notice he can retire from the partnership business. In accordance with the agreement by the partner, if there is agreement that the partner can, by giving notice of the partner will retire after, suppose one partner has an agreement, after completion of 2 years he will retire from the business, then in accordance with the agreement by the partner or with the consent of all the partners. If all partner agrees, then one can retire. So what are the points which require attention? First, treatment of goodwill. Goodwill, all of you know, in the previous video we discussed, it is the reputation of any partnership firm, and due when all the partners are running the business for a longer period of time, the existing business gains importance. That means the profitability increases and the reputation of the partnership firm increases. As a result, any partner, he retires from the partnership business, he wants his share of goodwill. That means he will tell, I run the business for 15 years or 20 years, now business is getting profit and it is having reputation in market, so you value the goodwill and give my share. Then all of you know that assets are retained in the balance sheet, assets and liability in their book value, even book value by reducing value, but the market value may be different. On retiring partner, he wants that there must be revaluation of the assets and liability. If there is profit, he will take his share. If there is loss, he has to suffer the share. Then revaluation as liability. Then treatment of undistributed profit losses. Suppose there is any undistributed profit there, he will get the share in their profit sharing ratio, old profit sharing, that is agreed ratio. If there is undistributed loss, he has to also adjust. He will pay from his capital. Then share of profit up to the date of retirement. Suppose the partner is retiring at the middle of the year, he will get his share of profit for the period is in the partnership firm. Generally, the partners retire at the end of the year, or that means the beginning of next year. But in case of death, it can happen anytime. So in case of death, the share of profit up to the date of death calculation is very important. But in case of retirement, it is done in a planned way. One partner retires from the partnership firm in a planned way. So generally at the end of the year or at the beginning of the year, the partner retires from the business. So there is no difficulty of calculation of profit. Then calculation of total amount due to a returning partner. We will calculate the capital account. If it is fixed capital method, we will calculate one capital account, another current account, all adjustments done in the current account. Then at the end, the capital account, the current account will be balanced, capital account will be adjusted with the current account. If it is fluctuating capital method, only one account, that is capital account, will maintain, all adjustments done here. As per the agreement, the retiring partner may get some portion in terms of cash, for other his loan account will be created. That is a liability for the partnership, existing partner or partnership. Then settlement total amount due to retiring partner. Here we will calculate something, that is ABC share profit losses ratio of 4:2:1. If B retire, what will be the new ratio? Nothing, no problem. When B retires, remove these two, so ratio is 4:1. ABC 4:2:1 means A was getting 4/7 of profit, B was getting 2/7 of profit, C was getting 1/7 of profit. Suppose B retires, we remove these two, 4:1, that means A will get 1/5 of profit and C will get 1/5 of profit. Second, XYZ shares profit losses equally, that means 1/3, 1/3, 1/3. Z retires and his share is acquired by X and Y in the ratio of 3:1. Here there is difference because previously they are getting 1:1:1. That means X 1/3, Y 1/3, Z 1/3. Then Z retires. His 1/3 share will be taken by X. So X will get, that is 2/3 of 1/3. That is 2/9. That is X. Y will get, that is 1/3 of 1/3. That is 1/9. So X new share will be the old share plus amount share received from the retiring partner. His old share was 1/3 plus 2/9. So it is 9, then 3 plus 2, 5/9. 5/9. And Y's new share will be Y getting 1/3 and he will receive 1/9 from retired partner. So it will be then 9, 4/9. So this is the new profit share ratio will be 5:4. 5:4. Calculate new profit share ratio of the existing partner. Then here X, Y, Z are sharing profit losses in the ratio of 4:3:2. Z retires. New ratio is given 3:2. So X, Y, Z. X 4/9, Y 3/9, Z 2/9. Z retires and new profit, this is old profit ratio, new profit sharing ratio, this is old ratio, old profit sharing ratio, new profit sharing ratio of X is to Y is given 3:2. That means he will get 3/5 and Y will get 2/5. So we have to calculate the gaining ratio. Gaining ratio means he is getting more. So when a partner will retire from the business, old partner will get the benefit out of his retirement. That means old partner's profit will be increased. So when it is increased, the old ratio minus new ratio. 3/5 minus 4/9. So it is 45, then 27 minus 20. That is 7/45. here X gaining is 7 by 45. Y was getting, now it is getting 2 by 5. So previously getting 3 by 9. So LCM is 45. Then 18 minus 15, 3 by 45. So their ratio is 7 by 45 is to 3 by 45. Their gaining ratio, that is 7 is to 3. Their gaining ratio is 7 is to 3. What is given? Our question wants to calculate the gaining ratio. So gaining ratio is 7 is to 3. Then we will solve one given problem. For solving a problem, we have to prepare the revaluation account, capital account, and balance sheet on the date of retirement of a partner. So, we will first read the question and understand what is the impact of this question. So, this is given below is a balance sheet of Raja, Rani and Pradhan who were partners in a firm sharing profit losses in the ratio of 5:3:2. Capital accounts of Raja was 4,20,000, Rani 3,70,000, Pradhan 3,32,000. Total 11,22,000. Reserve fund, that is undisturbed profit, was 1,50,000. Creditor 1,12,000 and bank overdraft was 97,000. Then asset side, land 7 lakhs, machinery 3 lakhs, furniture 50,000, debtors 1,80,000, stock 1,75,000, cash 76,000. So total of both assets and liabilities is 14,81,000. On 1st April 2024, Pradhan retires from the partnership firm with the following adjustments. Our new partner will allow the existing partner will allow the retired partner on following terms. First, goodwill will be raised in the business to the extent of 2 lakh. That means goodwill account debited to the extent of goodwill account debited, that is 2 lakhs. To existing partners capital account, that is to Raja, then Rani, then Pradhan. Capital account. That is, so their profit ratio is 5:3:2. That is out of 10 share, 5 by 10. So out of 10, 2 lakh, Raja will get 1 lakh, Rani will get 60,000, and Pradhan's capital will be created by 40,000. This is being goodwill raised at value. Being goodwill raised. This is the first adjustment. Then there is stock reduced by 10%, furniture by 5%, machinery 11%, reserve for bad and doubtful debt to maintain at the rate of 5% on debtors, and rupees 2,000 to be written off for creditors. Then with the consent of all partners, the retiring partner will take 50,000 in terms of cash, and remaining amount will be credited to his loan account. So we will prepare one revaluation account. Revaluation account is otherwise known as profit and loss adjustment account. We can write revaluation or profit and loss adjustment account. So we will prepare debit side, credit side. So debit, credit, then first decrease in the value of stock by 10%. So when stock is decreased, we will put the formula: increase in assets should be debited, decrease in assets should be credited. So in particular, write to stock. Stock account is decreased to the extent of 10%. So 10% of stock is given 1,75,000, 10% is 17,500. Then furniture reduced by 5%. to furniture, because decrease in assets should be credited. So furniture is reduced by 5%. The value of furniture was 50,000. 5% means 2,500. Then there is decrease in the value of machinery to the external 11%. To machinery, that is 11% of 3 lakh, that is 33,000. Then provision for bad and doubtful debt, that is increase in liability should be credited. 5% on debtors. So we write to provision for bad and doubtful debt, that is 5% of sundry debtors. Sundry debtor is given 1,80,000, then 5% means 9,000. Then rupee 2,000 to be written off for creditor. Creditor, that means the business has purchased on goods on credit basis to the extent of 1,12,000. The supplier will write off, will reduce 2,000. That means decrease in liability should be debited. So write by sundry creditors 2,000. 2,000. Here remember, when debit side is heavier, that is loss on revaluation. So we have to total the debit side 000. 62,000. Out of 62,000, 2,000 is the by creditor. So write by capital accounts. So loss on revaluation will adjusted from capital account of all partners. Loss on revaluation. So it is in the old ratio, that is 5:3:2. By that means Raja, out of 60,000, 5/10 will be shared by Raja. That means 60,000, 5/10 means 30,000. Then Rani, 3/10 into 60,000, 18,000. Then Pradhan, 2/10 into 60,000, that is 12,000. 12,000. So total loss is 60,000 and credit total is now 62,000. Draw two parallel line to close the account. Then we'll prepare capital accounts of partners. Capital account of all the three partners. So we'll write each side 4 columns will do. So particulars, then Raja, for Rani and for Pradhan. Then here also one partner Raja, second partner Rani and third partner is Pradhan. So this is all about the capital account of partners. So write capital accounts and the opening date as on, that is 1st April 2024. So particulars, here debit sides, here credit sides, then Raja, Rani and Pradhan. Then particulars, Raja, Rani, then Pradhan. Goodwill already we have to post here. Okay. Pradhan. So opening balance, that is credit balance. Opening capital there, so we write by balance brought down. Raja's capital was 4,20,000, write 4,20,000, and Rani's capital was 3,70,000, that we will write here. Then Pradhan's capital was 3,32,000. And there is undistributed profit of 1,50,000. Reserve fund is an undistributed profit. It is credit balance. So we debit it to close the account. So write reserve fund account debited. Amount is 1,50,000 to Raja, to Rani, to Pradhan. To Rani, to Pradhan. So it is ratio is 5:3:2. So 50%. Raja will get 75,000. Then he will get 45,000. Pradhan will get, the returning partner will get 30,000. So write by reserve fund. So reserve fund we will write here it is 75,000. Here it is 45,000. Then here 30,000. Goodwill also we have already done. By goodwill of partners. So goodwill will rate to the extent of 2 lakh. So here 1 lakh. Here, so goodwill 20,000 into 4. 5 into 3 to 2. 1,000 into 3, 60,000 to 40,000. So 2 lakh goodwill is distributed in the books of the new part after retirement of old partners. Then there is loss, we write to revaluation accounts. So our profit loss adjustment account loss. Amount of loss will be shared by all the partners 30,000, then 18,000, then 12,000. Now we total the credit sides of partners. 4,20,000 plus 1 lakh plus 75,000. Whether anything is there? Debtor, bank overdraft, land machinery, goodwill. Is that for downside? Okay. Then we'll total 4 lakh plus 4,20,000 plus 75. 4,95,000, 5,95,000. So here it is 4,75,000. Here it is 4,02,000. Then 30,000 debit is there. First we will close or will adjust Pradhan account, retiring partner. Here it is 12,000. So 4,02,000 minus 12,000. 4,02,000 minus 12,000. So he is getting 0, then 9, 3,90,000. So 3,90,000 means 50,000 he will get in cash. So to cash 50,000. Then to Pradhan's loan account. The remaining amount, that is 3,40,000. Then here 30,000 means 5,65,000. Here it is 18,000 minus means 4,57,000. Yes, to balance. Here we write to balance carried down. To balance carried down. The amount we write here 5,65,000. Here we write 4,57,000. Here already he is retiring. He retired. So 5,95,000. The total 4,75,000. Here it is also 4,02,000. This is all about the capital account. Now we will prepare a balance sheet in the books of the firm. That is the new partner's balance sheet. So for balance sheet, we will do balance sheet of Messrs. Raja and Rani, because Pradhan has already retired. So Raja and Rani on the opening date as on 1st April 2024. So this is left hand side, right, that is live side, right hand side, asset sides. So we'll do like this. Amount. So all of you know balance sheet is prepared at a particular date. So it is liability side, liabilities, then amount, then assets, amounts. So on live side you write first capital accounts. Capital accounts. The Raja is, the balance amount is 5,65,000. 5,65,000. Then Rani 4,57,000. So total comes to, that is 0, 0, 0, 10,22,000. Then comes reserve fund already adjusted. Then creditor was 1,12,000. Then minus 1,12,000, 2,000 adjusted. So 1,10,000. This is creditor. Then loan accounts. Loan account is Pradhan's loan account 3,40,000. Pradhan's loan account 3,40,000. 3,40,000. Then asset side first land is intact. Land was no adjustment there, so land was 7 lakh. Then machinery, from machinery it was 3 lakhs minus depreciation, that is decrease in the value, that is depreciation. The amount is machinery 11%, 33,000, so it is 2,67,000. Then after machinery comes furniture. Furniture is 50,000 minus depreciation 2,500, 5%, less depreciation 2,500. So net amount is 47,500. Then after furniture comes goodwill. Goodwill raised to the extent of 2 lakhs. So goodwill will write 2 lakhs, the value 2 lakhs. Then comes debtors 1,80,000. So debtors was 1,80,000 less provision we kept 9,000. Less provision for bad and doubtful debt 5%, 9,000. So it is 1,71,000. Then stock was 1,75,000 less decrease in the value of stock, less decrease in the value of stock on admission of a partner, that is 10%, less decrease, that is in value, decrease in value, it is not depreciation, decrease in value, that is stock 10%, 10% 17,500. So write 1,58,000, 1,57,500. Then cash was 76,000 and he has paid cash 50,000, less paid to Pradhan. We can open one cash account also, that is 50,000. So net cash is 20,000. So now we total the asset sides. So asset side total is 1,71,000. 1, 8, 9, 16, 17, 18, 19, 20, 21, 22, 23, 24, 25, 26, 27, 28, 29, 15,063. Okay, then here also 0, 0, 0. No, it is 2,000 is reduced. So Raja, Rani, loan is 3,32,000 plus 30. So it is reserve fund. goodwill. Then it is 2, no, that is 91,000 there. Oh, bank overdraft was 97,000, that we have not written. Bank overdraft, that is 97,000, that we have not written here. 97,000 means here 15,69,000. Here 15,69,000 and here 1,71,000. So it is 7 lakh. Then machinery 3 lakh minus 33, 2,67,000. Then here it is 47,500 stock, 10%. Then goodwill 2 lakhs, then 1,71,000, that is debtor. Then stock 1,57,500, 157,500, cash 20,000. Cash was 76. Okay. Cash was 76 minus 50, 26. So total comes to 15,69,000 of both the sides. So cash 76, not 70. So balance sheets talents, that is 15,69,000. So it is now both side talent, that is 15,69,000. This is correct balance sheets. So thank you for watching the video. Don't forget to share the video to all of your friends and relatives so that everybody will be benefited. It is very important for all commerce stream and bankers. If anybody has not subscribed, try to subscribe.